Hi, everyone. You're in the right place. This is the webinar on bridging the gap, how development finance institutions can accelerate private finance for a greener future. People are just dialing in now, so we'll give it a couple more minutes till numbers get there, and then we'll get going. We currently have live broadcast via LinkedIn as well. This webinar will be recorded. So there are multiple ways of dialing in and seeing. For those of you that aren't aware of the LinkedIn broadcast, all our webinars are broadcast to what is generally a much wider audience on LinkedIn and then available for recording afterwards. And the recordings are also available on our website at climatebonds.net. But today, of course, we're privileged to have with us a couple of key speakers to comment on the kinds of issues we're raising in this report and to talk about, more to the point, what their institutions are doing as an example of this area. Let's get started. I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. We have published recently this report called Bridging the Gap, How Development Finance Institutions Can Accelerate Private Finance for a Greener Future. Look, you kind of know, if you're dialing into this particular webinar, you're going to know what the basic challenges are about climate change, emissions reductions, impact, the need for adaptation and resilience. Not to mention, in emerging markets, the need to figure out how to navigate economic opportunity for countries in the context of these big changes that are happening globally. You know, if policy changes all around the world, the clean energy revolution is well and truly underway. More than 90% of all investment in electricity generation last year was in clean energy. That's an indicator of what's happening. More than 50% of all cars sold this year in China will be electric vehicles, and so on. So if you're in an emerging country, the sort of countries that Amalie works with the British International Investment, you need to be thinking about what's your economic future like in here, and what kind of different investments do we need to make to ensure jobs, health, welfare, business opportunities locally to develop our societies and economies. And while we're at it, address resilience, because we have to deal with the increasing severity of the impacts of climate. And we have to prepare for that now. So that's the background. The capital investment required to shift this planet onto a more sustainable footing in the context of climate impacts is vast, is huge. It's the many trillions of dollars. Just on the mitigation side, McKinsey's a couple of years ago was saying $9.2 trillion a year. And then we have a resilience agenda and so on. Look, some of that is the reorganizing of existing capital flows to make sure they're addressing risk factors that we may not have addressed in the past. For example, infrastructure now needs to deal with increased heat and increased storm strengths, etc., etc. Whatever, there's a shortage of capital. A lot of this is new and unprecedented. To do that, we have to have some way of bridging the gap between this new stuff and the capital pools that we must mobilize. There's not enough public capital in the world, nowhere near enough public capital. So we will need to reorganize private capital flows to be able to support public capital measures to achieve the changes we need to do. So to do that, we need development banks and development finance institutions to be focused on how we manage this new world we're going into and how we support our countries and institutions do it. Well, we're kind of lucky. There are more than 500 development banks in the world, scattered around the place. In Brazil, they're all over the place. Every state has one. It's incredible. Unfortunately, most of them are not at the moment very focused on how they bring in private capital behind them, how they increase the flows, how they educate private capital on what needs to be done, emissions, mitigation, etc., seizing opportunities. So we need this close working relationship if we're going to navigate this transition we need to create between public sector pools of capital, exemplified by development banks, and the private sector. This report, that's what bridging the gap is. This report is fundamentally about that. Well, at least that's my theories. Let's hear what Lily Bird is going to say. So today, joining us, we have Lily Burge, who's the Senior Policy Research Analyst at Climate Bonds Initiative, who's been the primary author of this report, who's going to run us through some key findings, the executive summary, if you like, of the report. And then we're lucky enough to have with us Thibault Lemercier, who's the Senior Climate Officer at the Belgian Investment Company for Developing Countries, or BO Invest, if I can say BO, because, hey, it's the term I use. Thibault might correct me in a minute. Amalie Amin, and my dear old friend who we've been working together for years on these sorts of issues, is now the Managing Director, Head of Climate, Diversity and Advisory, what a fabulous title, at the British International Investment Company, Britain's development bank, if you like. So we've got the Belgian Development Bank, the British Development Bank mentioned. In this report, we've covered a whole lot of other development banks. Now, bear in mind, this is not about just how BII should do more. Of course, I'm always going to say to Amalie, BII should do more. That's my job. It's about how we help other development banks all around the world copy what BII and BO Invest have been doing and do more of it, so that the entire global pool of development finance can help us achieve our massive transition goals, extraordinary big transition goals. That's the theory. Lily, I think at that point, cue to you. Tell us what's in the report.
Thanks, Sean. So in this report, we have focused on European DFIs, just to clarify, but the recommendations and barriers are common across the world. So it's a sort of, as Sean mentioned, there's DFIs all over the world, development banks across continents, and these recommendations are important. So if you're like, oh, I'm not from European DFI, it's still relevant to you. Keep listening. So can we jump to the next slide, Letitia? So we have here, just for clarification, this report defines DFIs as majority publicly owned financial institutions which support sustainable development in low and middle income countries. So we're taking possibly a broader definition of DFIs than you might have seen elsewhere. And we sort of did that on purpose because that meant we could look at some of the multilateral DFIs like EIB, EBRD, Council of Europe Development Bank, and so on. And from this graph, we're looking at balance sheet size as a sort of proxy for investment and mobilisation capacity. And the first thing to note is European DFIs have a huge range in what their sort of capacity is, which means that they will face slightly different challenges, and we can't expect the exact same thing from each of them. And later we'll hear from Amalie and Thibault, who are from two DFIs at sort of slightly different ends of the spectrum, which should hopefully shed some more light on that. Next slide, please. So the DFIs also show a huge range in their targets and tools they use for mobilisation. So firstly, only 37% of the DFIs we assessed actually have a form of capital mobilisation target. And we seem to see that those with targets do use more mobilisation tools. However, those also seem to possibly be more weighted towards transaction level tools, which we'll kind of get into later, which is when we get into challenges of what your mobilisation target is and what it's actually incentivizing. And then the second important point is that mobilisation levels are still pretty small. So the highest level we saw, which is based on our own calculations from publicly available data, was that the highest was about 20% of balance sheet size down to about 1% of balance sheet size. This is just from not being able to assess all of the DFIs, just based on those that are reporting against the joint MDB mobilisation methodology. But this is still, it's not a very big scale, sadly. And when we look at, as Sean mentioned earlier, public finance capabilities are far lower than the need that we see for climate investment. So we really need to ramp up these mobilisation levels significantly in order to be able to actually meet our climate finance targets. And this graph just gives the numbers of DFIs using each of these tools. We can see that some are very popular, some are less popular, and we'll sort of dive into some of those later. So onto the challenges. we've got a range of barriers that prevent certain DFIs from ramping up their mobilisation efforts. The first one is their own objectives. So, as I mentioned, not all of them have a mobilisation objective, and they have challenges sometimes in the sort of balance between prioritising green and social objectives. Often, many of the DFIs were founded for more social development focus, so bringing in green investment into all of their operations can be difficult. And then within their own policies, often we see challenges in risk appetite, which is something I think often DFIs are probably very bored of being told, take more risk, your risk appetite is too low. But the thing is, it's limited by their needing to preserve high credit ratings. If they're borrowing on capital markets, they need to, they want to be able to access capital markets at low cost. They want to have a high credit rating able to do that. So they kind of get into a bit of a sticky situation there. And though there are other kind of policies which are possibly easier to tackle, such as the fact of them holding investments all the way through project life cycle. They don't on-sell them to other investors. And this, again, can sort of clog up balance sheets. They're not able to help generate more investments. Then we see information and expertise gaps, both sort of within DFIs in terms of familiarity with mobilisation tools, familiarity with climate investment, taxonomies, and so on, and from the investors. Investors are often not very aware of the opportunities they might have for co-investment with DFIs. We have risk appetite again, it's very important. But we see lots of challenges with risk appetite stemming from their shareholder expectations, their shareholders being their national governments. And then they also face massive challenges in their countries of operation, from local currency risk to low sovereign credit ratings, which limit all credit ratings within that country, to political uncertainty. That's a whole range there. And then they are also finally challenged by their own policy and regulatory environment, from EU regulation, or British in the case of BII, and that can challenge them in terms of what they label as green, what they can face. This is a sort of problem we see quite frequently from all investors, or sort of challenges of green financial regulations, sort of teething issues as these regulations are introduced. So what can we do? So we've got 30 recommendations for actionable sort of near-term action for DFIs, their shareholders, and their regulators to unlock capital mobilisation. And we're just going to look at 5 key ones here. So next, please. So the first one is to look at mobilisation targets, and these need to be based in a really clear definition of mobilisation, which incorporates all the tools available to the DFIs, which will ensure that all these tools outlined here are considered in investment decisions. So currently, definitions tend to cover, sorry, Letitia, one please. These, I'm very high-tech in my slides. Currently, definitions cover a reasonably limited number of mobilisation tools. We want them to cover, Letitia? Yeah, there you go, very high-tech, all of the tools. So we want these targets to be based on definitions which incorporate all these tools and also focus on climate and sustainable development outcomes. We want mobilisation not to be seen as an end in itself, but as a way for DFIs to maximise their efforts to contribute to climate and social objectives. And then, of course, this results in a bit more complex reporting. Sorry, back please. Alongside the sort of headline dollar figure of total amount of direct capital mobilised, we also need to cover sort of indirect mobilisation metrics, such as the impact of early stage project development or sort of technical assistance with transition planning, which you probably can't necessarily put a number on. So that requires sort of a bit more thought and a bit more sort of qualitative reporting possibly, and just adding that kind of nuance, which is really important, just so we don't focus on the easy to report tools. Next please. One of these tools, which is possibly not so easy to report, is on-selling, which I've already mentioned. So only 26% of the DFIs we analysed use on-selling strategically. And it's an important way to free up balance sheets and mobilise private investors. So what we are suggesting for DFIs is that they could put in place an on-selling committee, which could review investors to identify projects ready for on-selling, based not only on commercial viability of the investment, but on a sort of impact assessment of whether the continued presence of the DFI in that investment will sort of increase impact, or whether the impact can be achieved without the DFI's contribution. And BII is one of the DFIs with strategic on-selling. So they've got an exit approval process which assesses commercial and impact returns alongside each other. And they sort of aim to ensure sustainability of impact after exits. This is one of the ones we sort of highlight as a useful example to other DFIs. And next, please. Another big recommendation is improved transparency for private investors. Already mentioned this problem of investors not really knowing what they can co-invest in with DFIs, but they also just lack information possibly on the risk exposure in markets they're unfamiliar with. So increasing information from this specific database, the Global Emerging Markets Risk Database, which 43% of the DFIs are members of. This has got amazing data on what are the credit risks of emerging market risks that they've invested in. Increasing availability of this data to private investors will probably increase participation in emerging market deals, because often the private investment risk perceptions are sort of higher than the actual risk exposure. So this will sort of address this issue. Plus, this data availability will sort of reduce investor due diligence costs that they have to undertake in order to take part. And the EIB, where this database is housed, has stated that the consortium is committed to making statistics available. But yes, we're kind of say yes, please, now. And then this would also probably indirectly kind of mobilize investment by providing investors with information they need to just invest independently of the DFI, not to participate in DFI transactions, but just go it alone. And then our next recommendation is on shareholders. So I mentioned earlier that we see risk perception often stemming from shareholders. So we see that there's a huge range in return on equity for DFIs. Again, this is based on our own estimations for just 2023, based on their publicly available data. But it suggests that some DFIs have got room to target a lower return on equity with, the sort of top end, sort of getting near that of commercial investments. So as DFIs are viewed by their shareholders as a way to realise their climate finance commitments, their return expectations should reflect this. And targeting a sort of lower return on equity would effectively increase the level of concessional investment, that they can make, as investments wouldn't be expected to make commercial returns. In addition, shareholders could also revise down their dividend expectations, reducing the proportion of profit paid as dividends would increase reinvestment capabilities. And I think DFI shareholders will need to assess whether they need these dividend payments, because this would again increase provision of concessional financing by the DFI. And then our final recommendation is very in line with climate bonds, is to increase green bond or social sustainability bond issuance. So only 9 of the DFIs we assessed currently issue debt. And amongst these, you can see there's a huge range in the proportion of the debt that they issue that is labelled green, social sustainability. Obviously, these DFIs are investing in green social sustainability, so there's sort of no reason why they can't rapidly increase the proportion of debt that is labelled. This will provide a really important signal to investors on their climate commitments and could enable them to access better pricing, i.e. the sort of gold star of North Star of any issuer, the greenium. And this would also ensure that they can help stimulate local markets if they issue local currency bonds, because they can firstly issue in a local currency to provide local currency lending, and by issuing in said local currency, they will encourage investors into investing in that wider market. And then, in addition, none of the DFIs has issued a sustainability linked bond yet. And obviously they have all these climate objectives in place, which could be used as the basis for sustainability-linked bond KPIs. Again, all of their investments should be aligned. So there is sort of no reason why this can't help them rapidly increase labelled debt proportions. And obviously, green bond issuance is an additional mobiliser of private investors. You bring in private investment through your bond issuer, through your bond issuance, you're bringing them in through your market creation. And this will hopefully, again, really sort of send a really clear signal. As we can see, only one has issued only green bonds, and we'd like all these bars to turn green. And that is it on the presentation. Here, the report is available online already. If you've got any questions about the report, feel free to put them in the chat and we can tackle them as we go into the panel discussion. And I'll leave it there. Back to you, Sean.
Thank you, Lily. Thank you so much. It's a good read, the report, so please have a quick look at it. At least we'll have a look at the executive summary. You know, the green bond issuance or the green social bond issuance is one of the easiest things to do. Not all banks can do it, of course. We appreciate there are structural issues and so on. But the reason I've got this logo up here with the Chinese name of client bonds is that on the weekend, the UK-China government conversations made an announcement that China's going to issue a green bond at the London Stock Exchange in the near future, sovereign green bond. Simple, draws attention to it, gets a bit of business going. There are so many easy things. It's a starter idea to get issuance going. And that, of course, encourages private sector issuers to participate and so on. Often they need the support of development banks and emerging markets in particular with technical assistance programs, but we have a lot of that. And one of the characteristics of European development banks is the extent to which we now have support programs for green finance in emerging markets. But of course, this report is focused on what European banks are doing. I keep saying as an example of the world, but let's hear a little bit more about, is it really an example of the world? Maybe, Amelie, I might start off with you, if I may. Tell us a little bit more about how all of this fits in with your climate strategy and BII's mandate.
Thank you. Thanks, Sean. Always good to be on a panel with you, even when virtually. And thank you really for the report and organising this session. I think as BI, I mean, we really welcome this focus on thinking more broadly around mobilisation. I think, Lily, you said, you know, mobilisation is a means to an end. And so we really need to focus on what are the real world outcomes that we're delivering here. And actually, when you look at what DFIs such as ourselves are doing, we're often mobilising in a range of ways, both directly and indirectly, which I'll say a little bit about later. But at the same time, you know, the definition that we all tend to apply under the OECD is rather more narrow, which has the benefits. It creates clarity. And it avoids overcounting, but by only counting commercial capital that is mobilised directly at the sort of project transaction level and or fund level. But on the other hand, there are a range of other ways in which we are already mobilising, I think, as your report really well points out. And that's something at BI we've been doing. But also actually produced a report on that a couple of years ago to look at different types of mobilisation pathways, and you know, can certainly refer others to that. I think your report has also referenced that as well, which we really welcome. I think, you know, when we think about the real world outcomes we're trying to achieve, and you know, what are we trying to really do as DFIs, as impact investors? Well, of course, we are trying to really scale and accelerate the transition to effectively sustainable development. So the focus mainly on green, on carbon, climate related, decarbonisation related mobilisation. But I certainly hope, and that's an area we're also very focused on, how we can mobilise more for adaptation and resilience, as you referred to, Sean. I know you've been doing some great work on a new taxonomy in that respect for adaptation resilience. So for us, we have been working to mobilise through various different types of structures in different ways. I mean, BII, CDC, historically, sort of probably 20 years ago, we were very much an equity house. And so a lot of the way in which we have mobilised has been through equity investments. One really good example, I think, which is a very good example of domestic mobilisation, has been in India, where we, in 2018, we partnered with a local renewable energy developer, Ayana Renewable Power, to create a platform where we invested equity. Initially, we were 100% shareholder there, to really scale utility scale renewable energy power in India. And in that initial context, we actually mobilized a lot of debt alongside the investments via the platform, so which wouldn't not count under the sort of more traditional climate mobilization methodologies that we all follow. So that really wouldn't count. And then at the same time, a couple of years later, we actually mobilized a domestic Indian sovereign wealth fund, National Indian Infrastructure Fund, NIIF, that now is over 50, I think almost 52% shareholder of Ayana. And again, that wouldn't count as mobilization, but it's clearly brought in some very important domestic capital into scaling India's renewable energy sector. And I think the original target for Ayana was like 300 megawatts in 2018, and now the goal is 4 gigawatts, and that's both greenfield as well as through acquisitions of existing renewable energy assets. So, you know, I think that's a really good example of, you know, what we've done and how we are focused on doing much more as well. And the sort of rather narrow definition of mobilisation is, whilst it's good to be conservative and not overcount, I think we all acknowledge that. At the same time, we also need to recognise the importance of creating the right incentives internally within DFIs, so that teams are really going out looking for these sort of innovative ways of mobilisation. And so I think, you know, as your report really calls for, by broadening that definition, it can really help create the right types of internal incentives. So really, really welcome that. I'd love to say a little bit more about some of the mobilisation we've done in other contexts in Africa, but maybe I'll wait till you come back to me for that, Sean. Thanks.
It'll be great. It'll be great to hear about that, Amelie. But let's bring in Tibor, because Tibor's in an unusual position. He's just put through a climate strategy for BioInvest. He's been running it himself, and so I'm interested in your story, Tibor, about how that's worked and what the challenges are and the wins are in embedding that with the whole organisation. Well, tell us your story.
Thanks, Jen. Thanks a lot for the opportunity to speak, and indeed sharing a bit the experience from another perspective, from a smaller DFI of this world. And then welcome, hi to everyone online, of course. So yes, I'm Thibault, working for the Belgium Development Banks, leading the climate practice, and definitely it has been a journey since I joined. And just a few words on being from Bio, a smaller one. We like to say that we are indeed a bit more flexible than bigger ones. So that is a positive one, definitely, where we can explore areas, explore more innovative solutions. So that definitely helps sometimes in the mobilization context. But we are also, we like to say also that we are really focusing on high impact. So just a couple of words to put the context of the mobilization topic and the climate, is that definitely Bio is a bit more focused on smaller entities, smaller organization. We focus a lot on SMEs, We focus on a lot on the agri sector and also on smaller energy projects. So that is really the DNA of bio. So also like directly, indirectly, in terms of mobilization, we have a few tools and fully agree with Amélie and linking to the report that even though we don't have a direct mobilization targets, like as an institution, we think and we really want to bring our own participating in that movement through different tools like co-financing, definitely equity investment, all those are really important. And I'm going to link that to the climate strategy. So like your question initially was really focusing on the key challenge for smaller DFIs as us in implementing a climate strategy. And what I'm going to say is not new. Huh? It's the basic ones, really, but still they are really valid. I think the common language is having this common language is definitely the first one. And when we implemented that climate strategy, mobilization was always like like behind our heads and really thinking like, how can we implement a strategy that really speaks to that speaks to the same language, so that we can use that strategy also in our more medium long-term mobilization exercise. And that is still a very, very key challenge. Being from the EU, we have a really strong community of EU DFIs and working day to day also with BII colleagues from the climate team. So we exchange a lot. We have common ambition, we have common standards a lot, but still we still need to work on a regular basis to align this language of so that is definitely the key one. And you spoke a lot in the report also on the challenges, like having that in the EU sustainable finance framework is definitely difficult. So that's the first one. And the second one is really still basic, having the right tools and the right data to really assess and monitor impacts. And so very basic, but let's make it a bit practical for bio. So really common language, our new strategy, we wanted to build around 3 pillars. And so the first one is really pushing for really, and it's in line with the basic triangle, risk, return, impact. So it's really always how to balance those. And so we really want to also align with the like international thinking of an EU regulation frameworks, like how do we ensure that we do no harm, do no significant harm. So that's the basic one. And that's still a very ongoing conversation with other DFIs. How do we ensure for the climate perspective that we align with the Paris alignment, like the key elements there. And still like having the do no harm definition from the EU, being an EU institution, applying the EU standards is a real challenge for us because we invest in developing world in a completely different context. So we need more tools and we need more frameworks like taxonomies. And I know, Chan, you're working so much on this, but we still need more because that is still missing. And the global taxonomy framework would be really helping us, because we need to make the EU realize that as a DFI, we're not investing with the same kind of principle, the same kind of, it's not just in line with the EU, the Paris Agreement thinking about reflecting common but differentiated responsibilities. So how do you make this happening when you're an EU institution, when you have this responsibility, but you still want to align with the local context of the countries that you are really working with? So definitely, yeah, that's the first one for risk. And then for really the more the impact, of course, we have an ambitious targets related to green finance. And that is really key also for future mobilization. So we align with MDB common principles and DFI standards on that. But still, those kind of standards are not always reflected and applicable for private market participants. So how do you want to mobilize that if they are not using the same kind of targets? So we need to build bridges between the frameworks that we are using and the EU kind of framework. So that is still a very basic but real challenge for us. And then the last one, and I know BII is so much active on that, is really how to mainstream climate action through like focusing on transition finance. And that's definitely a key missing element. For being from a small DFI, I wanted to really, not so small, but really focusing on those smaller deals, like a lot on SMEs, mitigation is a key one, but it's not always the most relevant one when you really work with smaller organizations, SMEs in the agri sectors, smaller energy projects, of course, renewable. So we really try to focus more and more on resilience, and that is really key. And how do you really set the two challenges that I highlighted? Speaking the same language and having the right data. When you talk about resilience, which is so specific to the context of each organization you're working with, is a real one. So yeah, those are the type of challenges that I was facing as a new climate officer at Bio. And definitely we try to use those two to really attract potential. Like we have an ongoing fund, SDG for the Frontier Funds, which was really about mobilizing private capital. And we're really thinking about the next one, what we want to launch. And so definitely climate could be a key topic. And we need to make our stakeholders in that potential project understand how we manage risk, all the tools that are available at the EU level, for example, to really manage and reduce the risk to make those investments acceptable. But we also need to make them understand that it's a huge opportunity to diversify their own kind of the way they work and their own portfolio, which potentially from an EU perspective might be really risky in the future. So they need to expand the investment opportunities they are looking at. And frontier markets is definitely an opportunity that they maybe working with DFIs could be an opportunity for them to learn, get more exposed, starting a bit small first, but at least they get this experience from investors like us that have been working for many years in those contexts. I'm going to stop here, but yeah, just sharing some thoughts.
Thank you very much. For our listeners, you'll note two things about this conversation. The first thing is it's all about climate, but it's all about climate understanding that it's resilience, it's development as well. It's not just the narrow clean energy, even though that's critically important. It's a very broad agenda. But we don't have much of a conversation in Europe anymore about you should be doing climate. It's all about how. And the second thing I'm going to suggest to the listeners about this is listen to Thibault talk about the hows. It's all about how. It's complicated. I mean, we're trying to shift the planet here. It is clearly complicated, but there's a lot of, let's call it engineering work underway. And Malik talked about our climate resilience taxonomy work, which is one of the things we've done, which incorporates social, economic, nature aspects of resilience, not just physical aspects of resilience. And that, what, if you like, fleshes out the brief and the overlap between development and addressing climate in a way that makes it easier for emerging markets who are generally not so concerned. I mean, Thibault was referring to this. Mitigation is not the biggest issue for them. It's an issue for all of us, but they've actually got to prepare and adapt. So understanding the development aspects, the social aspects of this are really critically important. And our investors need to understand this is all part of sustainability, sustainable societies and sustainable returns. It's well, we're privileged to be working in a difficult but interesting and incredibly important area. I think, Amalie, how does that feel to you? You've been in this space for so long. You've worked at the Inter-American Development Bank, Treasury, and so on. What's your reading of the momentum of change in the space amongst DFIs? Because I worry that things need to change really fast. I think things are changing, though. No?
Yeah, thank you, Sean. And I mean, I think absolutely. And I think Thibault made the point very well that as DFIs, we're quite nimble. We're relatively nimble, often because we mostly only have one shareholder. So might be easier to bring change and develop new strategies and turn the sort of direction of travel towards an agenda such as this quite quickly, and nimble and innovative, I would say. I think also, I mean, we talk a lot about, and Thibault, you talked about the sort of taxonomies, and I think we worked on some metrics for adaptation resilience, and I think for us what we thought was important, and I think it's very similar to your taxonomy, Sean. We need to think about people, planet, and economy. and how all three come together. And I think that's obviously particularly important for emerging markets and developing economies. And so that's really, you know, I talked a bit about IANA. India, obviously, I mean, a really important country in terms of the extent to which the climate crisis will be tackled or not, you know, really does very much depend in large part on very large economies like India. You mentioned China, which it's great to hear, you know, they continue to lead on green finance. But it isn't just about the big emitting countries. Critical, and the energy transition and the transition out of coal and how to mobilize commercial capital into renewable assets and the grid infrastructure, increasingly important to enable decarbonisation, is key. But at BI, we've also been very focused on mobilisation in some of the frontier markets, as you mentioned, Tibor. I mean, we were one of the co-anchors, co-anchor investor in a Tanzanian shilling NMB bond, NMB Jami bond, alongside IFC, which actually issued initially in the Dar es Salaam Stock Exchange in end of 23, but last year was co-listed here on the London Stock Exchange, and that will provide significant financing for green investments in Tanzania. And I think you know, the largest issuance in East Africa. And what was quite important as well, we partner with FSD Africa, who are providing technical assistance to NMB banks so that they can better identify those green opportunities and then go and finance those. And I would say similar, another actually, which I think was really innovative in 2022, we worked with Symbiotics Investments to issue a green basket bond, which the first green basket bond, which was really to provide to finance small projects via micro, small and medium-sized enterprises, MSME lenders in Africa, South and Southeast Asia. So, you know, really important to recognise that getting that green finance down to local businesses, local entrepreneurs, you often go through smaller financial institutions. And so for them as small institutions, they're not going to issue a bond on their own. But so with Symbiotics, we created, you know, aggregated their issuances to create this green basket. And we came in last year with a follow on a further 75 million to actually increase that, particularly with a particular focus in India. And also very importantly, and I think this gets back to some of the maybe how we might do more indirect mobilization, we also provided almost, I think it's almost $500,000 of funding for technical assistance to help these lenders to SMEs further develop their own knowledge, capacity, and expertise to be able to finance these green MSMEs. So really important that we don't only think it's about scale when thinking about mobilization. Of course, when we are trying to get to that very smaller scale, it's critical that we work via financial intermediaries, and building the capacity of those financial intermediaries, you know, equally important. And that more indirect type of mobilization moving forward, I think, will become more and more important.
Whoa. Thibault, how does that fit with what you're thinking in this new climate plan? Are we, I mean, more of the same? Is this the right?
Yeah, definitely. I fully align with that, and I recognize, yeah, the great collaboration that we have around different EDFIs, of course. But yeah, Bio is definitely trying to learn and to push new project directly. But financial intermediaries are crucial for us. So we really to bring that scale, even though like the scale that we're talking about might be different between BI and Bio, but still working through funds, for example, local funds, and helping them putting in place the frameworks that is needed in order to address resilience. For example, we work a lot on agri sector, and those kind of funds have the local context knowledge they understand their clients, but still it is an evolving field. So really using them to set good practice on the ground into like management of climate risk, being physical first, but even in the transition risk, we see some cases more and more happening, like definitely a more mature market, but also it could be happening very quickly in those markets as well. Like transition risk is a real issue for fossil intensive organizations. So definitely it's making them understand those kind of risks is really really crucial. So being through funds, bringing those good practice cases, or working with financial institution, being MFIs. Bio works a lot with MFIs, so physical risk will be key for them to understand, being agri or non-agri. Those huge part of Africa economy is going to face critical challenges, or is already facing critical challenges. So they need to bring the expertise. They need to hire up the way they're going to tackle those. Or with bigger institutions as well, of course, having a more leading role in their markets to really bring the level of expertise that is needed. So yeah, that's where we try to work as well. We see technical assistance being key. We have our own tools, and we're really trying to also bring some of the EU tools along with our projects. Yeah, you have opportunities there, and definitely guarantee schemes. We talk about a lot about EU guarantees at the moment. Not so easy to implement yet, but the opportunity is there. So let's make the best of what is available. It's changing, not quickly enough, not always quickly enough, but yeah, we need to use the tools that are there at best as possible, and maybe correct the way they are being developed where we can influence.
I want to come back to EU and EU tools in a minute, but we just had a question from Zana Mons in the chat about debt capital burdens and the idea of mobilising domestic capital. And I'm conscious, Amalie, that BII and places like India has done quite a bit of that. Any insight into opportunities in Africa about mobilising debt capital and how's that working for you?
Yeah, I think,
Amalie, you try. Yeah, start us off.
yeah, thank you. Sorry, I was just going to actually read the question as well, but yeah, no, absolutely. And I think, I mean, of course, in a way, really mobilising domestic capital markets where they exist is going to be the first step, because one, there's more familiarity generally with many of the sort of I don't want to say, well, people often refer to political risk, but the sort of the political economy of that country will be obviously much better well known by the domestic players. But also, of course, currency risk as well is another key issue in terms of domestic mobilisation, not necessarily having then to address those risks on top of others. So, and then also, I mean, familiarity with the policy context, which is related to political risk, but different. So absolutely essential. And that, I think, as you say, the example in India is, and with Ayana was a really key example. We have, I mean, similar, we partnered with, banks in South Africa as well, where, there is a fairly deep domestic capital market. So I think where that exists, it's absolutely key. I think, of course, not every country, I mean, depending on the level of savings in the country, I mean, and the formal, how formalized those savings are, will depend on how deep the market is, and that doesn't necessarily exist in all our markets where we invest. So and that's where I think support via like FSD Africa, I think, who have been working very closely with Ethiopia actually to help strengthen their domestic financial system. There's been a big focus in Rwanda that has now a green finance center. So, that kind of work is really important as well, that sort of upstream support to help strengthen the the domestic financial system, and I say system, which will be both the markets, the financial markets, but also critically the role of regulators, the role of central banks. And central banks actually have been doing a huge amount on this. I mean, through the Network for Greening the Financial System and others. So, I think we need to recognise we need all of this. I mean, everything needs to really accelerate. We as DFIs, we can innovate, we can be quite nimble, but we also need those that work closely with governments, with central banks to really, also step up to ensure that we're moving everything along at a much faster pace to enable us to get to the scale of investment that is so critically needed.
Thibault, do you want to comment on that? Because I want to ask you about EU, but first, Africa.
No, quickly, I think we can always do better. I think, that's a big challenge, especially working on really, we have high ambition on LDCs and really those markets that are really challenging, definitely. But it is always an objective. So we do loans and equity. On the loan side, it is a way for us to structure companies, to structure those actors so that they can, and of course they will have the local ownership, always have the local ownership. So for us, it's really a tool for them to mature and to grow and then fly without the support of development finance. And really, as a Belgium investor, we are of course linked with state's objective, but we have really one of these objectives is to be untied. So we really want to support local players without having a really formal link with any kind of interest from Belgium at all. So it's this local anchorage, anchorage, I think, is really key for us. It is a criteria. It is a must. From the equity side, I think your comments from the report and Lily explained it well. It's one of the objectives also is to have a strategy about selling it. So this is always a starting point for us to see, okay, we're not there to stay. We are here to really help the growth and let someone else take over when those kind of impact have been somehow reached, or at least some of those organizations are able to fly without our support. So that's always from the beginning at the core of what we are trying to do, but yeah, still very challenging. So we can definitely do better. We need to find approaches that works to deliver that objective. Local ownership is definitely an objective, but a tricky one.
How useful have been the leverage target idea that you've introduced into mobilising internal staff to be thinking creatively about this? Is this, because I know BII's had that for a while now, is that a factor? Because we're thinking we have been thinking that's potentially a useful way to get people focused on different ways of working. This is leveraging private capital metrics.
Is that a question for Amélie? I'm not sure.
It's a question for you, Thibault, first, because you're fresh to this. This is new.
This is I'm not sure exactly. Internally, so your question is really about how to bring colleagues to think about it. This is a tricky one in a small organization when definitely we are really all focused on our day-to-day. So we have a really small team really trying to think about the next steps, and definitely that is part of the story. But it's tricky to have colleagues that are really focused on the day-to-day to add that thinking about mobilization on top of the rest is not easy. So we're not there yet. I have to say on that. And we still, we're learning from our piece for sure. So I will let Amélie discuss a bit more about this, because for us, we could
early days. Okay, Amélie, how's this worked?
Yeah, no, I mean, we're lucky we do have a mobilisation team. We're also very lucky that last year, in fact, the Prime Minister announced a new pool of concessional funding for BI, a mobilisation facility, so we can be even more innovative as we think about mobilisation. And in fact, at the end of last year, we issued a call for proposals alongside Mercer to asset managers to come with innovative ideas around mobilisation. And I think what's particularly interesting around that, which I'm very excited about, is we really also want to learn from that. You know, we really want to take that opportunity to learn from the market, you know, what is possible, so that that can also further shape our mobilisation strategy moving forward as well. So, you know, I think, as I said, I think, you know, we have got a team. But I think this is an agenda that we've moved fairly rapidly with. But I think this time next year we'll probably have a lot more to say, I think, as well. So yeah, watch this space.
We're coming to the end. Sorry,
maybe
Thibault, go ahead.
I misunderstood a bit your question. I thought it was hard to really mainstream mobilization in the world of bio. But of course, at bio, we have a task force kind of really focused on that. And we have a new management contract, a new CEO with a big ambition. So for sure, we have a team. And we're trying to really see, and climate being one of the opportunity inside of them. But yeah, there are a lot of different ways to do that. And so, yeah, sorry, I lost a bit what I wanted to add, but for sure, building on EU tools is one thing. Blending, for us, blending instrument will be really key. And so we also have to take into account the context of the political context of most of EU countries is tricky. Budget constraints, etc., is going to become the reality. Priorities are shifting. So we need also, global movements to push and advocate for that, so that it's raising in terms of political ambition, and then equipping our organization to do that better. Yeah, we are not yet there with trying to convince our authorities to put some more money on top, but we're discussing definitely with key actors. So let's see.
On that question I've asked, Lily, there's been some commentary from the European Investment Bank recently around the green asset ratio. What are DFIs calling for generally on those topics? Just as a final comment, I'm just to pick up Thibault's comments earlier about EU policy.
Sure.
What's the landscape?
Yeah, so this is, I think, Thibault's mentioned EDFI a few times, and that is this European DFI Association. So they're calling for, on sort of behalf of DFIs, for some key adjustments to EU regulation to sort of make it fit for purpose for the DFIs. And so the one specific issue, as people might have seen, EIB sort of concerns about the green asset ratio reporting on the EU taxonomy. And EDFI has suggested that we could include within the green asset ratio, optionally include non-European assets, because the problem is for all the DFIs are investing outside of Europe. Some are investing exclusively outside of Europe. These overseas exposures are excluded from the green asset ratio, which means they are calculating 0% ratios. And they're really worried that, an investor's going to look at this and go, ooh, thought you were a green company. So that's one of those sort of reasonably, hopefully, actionable sort of recommendations that the Commission could take forward in sort of making these regulations work for DFIs, because that's, we don't want reporting for reporting's sake. We want reporting to fuel a purpose and drive investment in the right direction. And clearly we will want reporting to ensure that DFIs feel able to make their climate finance available to not just within the EU, but crucially outside the EU, where there is likely the greatest need for sustainable investment.
Great points. We need to wrap up. Thibault, advice for development banks that are starting on this journey, particularly outside Europe, what would you say? And Amalie, I'm looking for a similar response from you as a parting comment to our listeners.
There so many things that they could do. So thanks for putting me on the spot for this. But I think we don't need to reinvent the wheel. So there is so much out there already, so many frameworks already available. So try to find the framework that fits your own priorities. Try to find the tools that really fits with your risk and your appetite that you really want to deliver, and then use the experience and what is available out there to get started. And step by step, it's a journey. So start small and use what is available is definitely my first advice.
Molly.
I think I agree with that. However, I would say I think also having, bold aspirations and vision, because whilst it's important to start small and bring and build the capabilities to do this, we do need to move fast and really shift the capital in the right direction now. So being bold whilst also building that support, I think, is key.
Thank you, everyone, for joining us today. Thank you especially to Thibault Lobassiere, to Amalie Amin, and to Lily Burge. Thank you, Lily, for all the work that you and the rest of the team, Fabio and so on, have done in putting together this report. Great report, available on our website right now if you go to clientbonds.net. The main thing, though, from this event today is thank you, everyone, for the work you're doing in development finance institutions around the world and the work you're going to do. We've got a hell of a lot of change to deliver in the global system. We've at least started. This conversation has given you a sense today of the sorts of things that are underway. It's working, it's happening, but of course, we've got a lot more to do. So thank you for that ambition. See you later, everyone.